Good morning, ladies and gentlemen. Welcome to this ODA Grain Market Outlook. My name is GaryPhillips. I'm Country Manager of ODA. I'll open this meeting. However, our principal speaker today is Sébastien Mallet, Managing Director of ODA. His paper, Will Prices Remain High in 2022? We will focus upon the domestic market, of course, but as well, the international perspective will be provided. Regarding your experience today, at suitable points in the presentation, we will pause and will pose your questions to Sébastien. The format of this event will be a formal presentation interspersed with the question and answer sessions. We'll pause at suitable times. Furthermore, we encourage you to raise your written questions throughout the presentation. During the presentation, please type your question in the section at the bottom of your screen, and we will have a question and answer session at the end of Sébastien's paper. Introductions and process addressed, we will now begin. ODA, who are we? We're a UK-based independent grain marketing consultancy. In the UK, we deliver our services to clients from Beccles to Cardiff, from Southampton to the borders, and of course, all points in between. Next slide, please, Sébastien. What do we do? Our role is to provide training, as you'll see on the left-hand side, information, and to provide price risk management advice for combinable crop producers here in the UK and across Europe. Sébastien, over to you.
Thank you very much, Gary, and hello to everybody, the one I know and the one I do not know yet. So yes, today we're going to review the market. We are about 2 to 3 months after harvest. The markets are and the prices are at record levels. We're trying to explain you why and give you a view on where we think they can go, and of course we will focus very much also on the new crop, what could happen next year, given the current very tight situation. So we consider ourselves as storytellers. So we tell stories to the farmers, market stories. We try to make a very complex world quite simple and quite interesting to read. So this is what we're going to intend to do today. We also intend to try to transfer some knowledge to the farmers so that they have a better understanding of the market and can take, of course, informed decisions when they market their grains. So let's start. We will start with looking at the prices, where they stand now, because for us, and certainly for you too, prices tell a story. So there's always a story when you look at historical graphs. We will then focus on the UK domestic market, because it has an impact on your ex-farm prices. There are many ways by analyzing the UK market. There are many ways to make money out of it, on quality, on import parities, etc., etc. Then we will look at why prices are so high in the world, because the world market is, I would say, responsible for 80 to 90% of the UK price. It's very important to look at what's going on in the world. And we will end this presentation looking at 2022 and trying to figure out where prices could go from where they are now, and what could happen for the new crop. So let's start with the prices. As I said just before, looking at prices is at history is for us very important to predict the future. So we will start by looking at the long-term future trend and then focus a little bit more on what's going on now. So this graph, which is a corn price graph over the past 20 years, I think is very illustrative of the commodity prices. First of all, because the corn is the most traded commodity in the world, and it's also very correlated to the wheat prices. So 2 or 3 things I think to understand on these prices, and this graph is illustrating well what has happened and what could happen in the future. So 2 or 3 things. First of all, what is interesting is that you've got different periods of volatility over the past 20 years. They usually last about 7 years. So we've had at the beginning of the 2000s 7 years of low volatility, followed by 7 years of very high volatility, then another period of 7 years of low volatility, and we seem to have entered for the last, I would say, nearly 2 years now in a high volatility period. So this is a good thing for farmers because it's quite illustrative here that when you have high volatility, you have better price opportunities for farmers. So we can already project that this volatility will remain high for at least another, I would say, 3 to 4 years. So a few reasons why prices become volatility and sometimes remain very, I would say, stable. So when the market is very stable, it's very simple. It means that the supply are meeting with the demand, which means the market is balanced. So when the market is balanced, the prices remain very stable and at a pretty low levels because it's their natural level. And when we enter a high volatility period, it means that the supply is not catching up, I would say, with the increasing demand. Another thing to take from these graphs is that prices, when they go up to where they are now, which is historical high levels, they never stay very long at these high levels, simply because they only go up for two reasons. The first reason is to ration the demand. There is not enough supply, so prices go up to destroy part of the demand. And the second reason is to incentivize farmers to produce more for the coming seasons so that the market can restock and prices come back to natural levels. So this is what always happened in the past. And that's very important to take into consideration because we are currently at very high record levels. And if we look at history, we will see that it is highly probable that next season or in the coming seasons, prices will fall down again to natural levels. And another very important thing is the level of prices when the market is balanced. As you can see at the beginning of the 2000s, the corn prices, when the market was balanced, were trading around $80, $90 per ton. 10 years later, when the market was again stable for a long period, prices were trading at around $150, $160 per ton, which is nearly the double of what they were trading 10 years before. And we reckon that the next step of stabilization that could come in the coming years, prices will again, in their stable levels, trade at a much higher level, which could be $200 per ton. So nearly 2.5 higher than 20 years ago. And the reason for that is very simple. The demand is going up in a linear fashion for the last 20 years. As you can see here on these graphs, the corn demand has gone up 100% in the last 20 years. The soya demand has gone up also 100% in the last 20 years. When the wheat demand has gone up only 30% in the last 20 years. So the reason for that is, of course, population growth, but most importantly, it's the arrival of the biofuel industry, which, just as an example, consume about 40% of the corn production in the US. Same for the soya, etc. And the third reason for the demand to have increased so much in the past 20 years is, of course, the higher buying purchase from many people in the world, in Africa, in China. I mean, in most Asia, people are eating much more meat than they used when before they used to consume protein through the vegetables or through the cereals. So it's a very impressive demand increase. It's very linear. The demand is going up, I would say, 2 to 3% in a straight fashion every year, which, just for your information, just talking about corn, 2 or 3% higher consumption every year is 20 million tons more consumption every year, which means that the world every year has to produce 20 million tons more corn to meet with the demand. For the soya, 20% is about 8 million tons. 2 or 3% is about 8 million tons to be produced to be produced every year, more than the previous year. And for the wheat, it's about I would say 5 to 10 million tons that we need to produce more every year. So where does the market find these new supplies? It's not in England, it's not in Europe that over the past 20 years we've been producing more. I mean, yields and acreage have been pretty stable. There is no real potential to increase. So the market had to find new places to grow the cereals. And part of it came from the Black Sea, where yields and acreage have increased. But the majority of these new supply needs came from South America, Brazil and Argentina. And for these countries, Brazil and Argentina, to be able to grow massively, I mean, when you say massively, we're talking about a 300% production increase in these two countries, which are Argentina and Brazil. You needed to farm new lands that were very far away from the ports, without any infrastructure, etc. So you needed to create all this infrastructure. And for farmers and investors to be able to invest and finance these new production sources, you need commodity prices to be high enough to be able to finance that. So that's why the market, I would say, natural level went up from below $100 to nearly $200 per ton now, so nearly doubled, just because cost to produce new supplies is much higher than producing it in England or in France because of logistical cost. So it's a good news. There is very, very little probability that you will see again wheat, barley prices below 100 or even below 140 quid per ton, simply because the world needs more supplies, and for that it needs prices to go higher for some investment to be made in some new countries. So if we look at prices now today, with the three major crops around the world, which are corn, wheat, and soya, it also tells you a story. It tells you a story that last year, you remember prices went up very strongly also last year. The story came from the corn and the soya market. As you can see, they went up on a vertical line, started more or less in November 2020, when wheat was only a follower. I mean, wheat didn't go up on a straight line. So it's really talking about wheat. It's really the corn situation, because we had a disastrous harvest in Ukraine, a disastrous harvest in Brazil, a pretty average harvest in the US, and in front of that we had an increasing demand from China that has led to very low stocks levels for these two major commodities, and it has taken all the complex up. So that was the story until July this year. But since July this year, not only corn and soybeans have been able to restock, because conditions have been pretty good in the US for the spring crops, and are also at the moment very good in South America, etc., etc. So corn and soybeans are, I would say, rebalancing themselves. When in July, as you know, and we will develop that today, on the wheat, the wheat situation became very, very, very tight, and this is fully related to weather events, multiple weather events all around the world, and we will review that afterwards. So we've just changed in July this year, during harvest in the northern hemisphere, from a corn-led market, corn was leading the prices up, to a wheat-led market. If yesterday prices went up to the roof, it's a wheat story. It's not a corn story, it's not a soya story. So this graph is illustrated perfectly what I've just said. This is the spread between corn and wheat on the world market. As you can see, the corn prices were going up much stronger than the wheat until June, July this year. And since July, the corn prices are going down, are going down, are going. I would say the wheat prices are going much higher up, or much strongly higher than the corn prices. So just looking at this graph, you understand that for nearly a year we've had a corn story. We are now focusing on the wheat markets because it's the wheat that is leading the prices up. So here, just a few reminders to say that I think it's pretty obvious on these two graphs. One is old crop. This is new crop. Sorry, there's a problem. This is May 23. It's really the old crop which is taking the prices up, and the new crop is just following by sympathy. We had a 300 euros price increase on the old crop, a 200 euros only on the new crop. So the story we will develop today is that the market is really taken up and supported by the very tight old crop situation, and we can very strongly start to question the ability of the new crop to keep on going up next year once the old crop problems will have will be a past story, I would say. Same for wheat. It's really again the old crop that is taking up the prices. The new crop is going up with sympathy. 68, 69 quid price increase on the old crop, only 50 quid on the new crop. So that's once again a very important thing to keep in mind, because we'll review that later in the presentation. Once the old crop problems and tightness will be behind us, sometimes in March, April next year, and then the market will focus only on the new crop, all this strength in the market might vanish. So let's focus now, before we come back to the world market, on the UK situation. And we'll focus on the main elements that can have an influence on your prices. So one of the first one is, of course, the currency. I mean, your ex-farm price is fully 100% correlated to the euro sterling currency rate. So it has been a headache for us during all the Brexit negotiation, when there was a huge volatility on the currency market. The volatility was much higher on currencies than on the commodity market itself. So we were becoming a currency trader rather than commodity traders for, I would say, for 3 or 4 years. So the good news is that since Brexit was signed and agreed, the sterling has been much more stable than it was in the past. So it's trading. It has been trading around the 0.85 level. It is now below 0.84 as we speak, which is a negative for our prices. I mean, the lower you go to 0.80, the more negative it is for our prices. The higher it goes to 0.90 or 1, the more positive it is for your prices. But anyway, it's pretty stable. So we consider that it is neutral when we compare it, of course, to the wheat, oilseed rape, etc. Volatility. So at the moment, we do not consider the currency as a real subject for us, and we don't take our decisions according to the currency. But bear in mind that this volatility could come back anytime, and in that case, we will look at the currency very, very strongly. A quick note on the euro dollar, because it's very important for the world markets too, especially for the European market. So the dollar is very strong at the moment, and this is coming from inflation risk in the US and the possibility of interest rates raising again sooner rather than later in the US, which is an element of support for the dollar, which has taken the euro massively down, and which is also a very strong element, a very supportive element for the European commodity prices, because the weaker the euro is, the higher the prices in euro are. So it is a supportive element for Matif prices. Talking about this crop, that I mean, the harvest we just had 3 or 4 months ago. So that was a very late harvest, a very complex harvest as we've had for the last 2 years. But nevertheless, we achieved, when compared to 2020, a pretty decent crop. I mean, there is a debate. DFRA is working on 14 million tons. Most of the traders are at 14.5. But anyway, it's a pretty decent harvest, wheat harvest in the UK, which normally should allow some feed wheat to be exported out of the country. Some of it, not a lot, but some of it. But we are going to be an exporting country talking about feed wheat in the UK. But the big problem, and we'll develop that right after that, is of course the quality. Because of very rainy and wet harvest, we've had, not only in the UK, it's a European issue. We've had a big issue with our bushel weights, which has not only bushel weights and some other issues on the qualities, but which has really harmed and lowered, I would say, the percentage of high quality wheat and milling wheat in the UK, which means that even if we will be in a position to export some feed wheat out of the UK, we will be very large importers of milling wheat because of quality issues in the market. A quick word on oilseed rape, because I think it's an interesting situation. As you know, since we are not allowed now to treat our oilseed rape against the flea beetles, etc., farmers have decided, a lot of farmers have decided to reduce or even stop producing oilseed rape. So when for many years we were producing more than what we consume in the UK, more or less we consume 2 million tons of oilseed rape in the UK, and we were producing 2.5. So we were a net exporter for quite a few years. And since 2019, and especially in 20 and 21, we are producing only 1 million tons when we consume 2 million tons, which means that we are a net importer of 1 million tons of oilseed rape in the UK, which we import from the continent, from Ukraine, from Canada, from Australia. But that has clearly a very strong impact on your ex-farm price, because if you are an importing country, your domestic price has to be high enough to be able to attract some oilseed rape from outside the country. And the direct impact for you is, before 2019, you were selling your oilseed rape at -14, -15 quid to Matif, and you are now being bid 0 to Matif. So your oilseed rape price, domestic price, has risen by around 15 quid per ton, simply because you are an importing country. So here again, the impact of the domestic market on your price is real. Talking about barley production, winter barley production. So as you remember, 2020 was a very poor year because of drilling conditions. 2021 is still a pretty poor year because drillings haven't been so easy to achieve last autumn. As a result, your production is, I would say, slightly below the 5 years average if we take out 2020. So it's a pretty average, but slightly lower production that the market could need, the domestic market could need. But you could still, with 2.5 million tons production, you could still feel that we could export some barley out of the country. We are exporting some of it, but we will see in the next slides that there is a real change in the consumption, in the feed consumption in the UK. And as you can feel on the prices, the feed barley in the UK is very demanded, and I will explain you afterwards. I think it comes from last year. I will come back to that right after that. Spring barley, we had a much lower crop, of course, than last year, because last year was farmers had drilled massively during spring because they couldn't plant and drill during the winter. So here again, we came back. We've lost nearly 1.5 million tons compared to last year, and we've had quality issues, which is leading to a very tight situation, because not only you have quality issues, you have a higher consumption because of pubs being open again, beer consumption being increasing again, and you have also a very high export demand for the farmers who are close to the coast. They know what I'm talking about. I mean, companies like Cefetra, big exporters, are massively buying some barley for export, simply because we've had quite a few quality issues on the continent too, because of very wet harvest. So all this is all these elements are pretty supportive for our market. So here I just wanted to focus by adding these four graphs. I wanted to highlight the fact that since last year, when we had a big deficit of feed wheat on the market because of a historical low wheat production in the UK, the feed compounders, the animal feed industry, has last year consumed much more feed barley than they usually do. And quite surprisingly, when there is more feed wheat available this year than last year, the animal feed industry seems to be consuming again more feed barley, even more than last year. When the 5 years average is there, last year we were above the 5 years average. This year we are even higher than we were before. So the feed barley seems to have, the compounders seem to be liking or to have adapt to last year's new situation, and seem to be liking the feed barley in their feed rationing and we can conclude from that if the barley prices are so supportive, they are trading at the moment at -10, -15 to feed wheat, it's simply because the animal feed, I would say, loves or prefers now using barley rather than feed wheat. It's not a question of price, it's a question, I think, of a real change of habit. And here, we will see here very, very nicely that the barley exports, despite a nice production in the UK, are as low as last year, much lower than the previous year, simply because the domestic market doesn't need to export that much because it is consuming much more than it used to. Talking about wheat imports, to our point of view, they are, because the UK is a net importer of high quality wheat. We knew it's normal that last year they did a lot. This is only for July, September. Very surprisingly, they started pretty low this year. So that can be explained partially because harvest was late in the UK. So it took a bit of time for the UK millers and traders to take into consideration the extent of low qualities we had. And also we had a very late harvest in France, in Germany. So that might explain why the imports have been so low. But we foresee that the October, November, December exports will be much larger than the figures we have now. So and that can be easily explained by the prices, because of course, as you've seen, quality premiums in the UK went up to the roof starting in September. Here, this is an HDB survey. This is just to illustrate the quality issues we've had this year in England. To make a long story short, last year we had 32% of the wheat meeting the Group 1 milling wheat specs. This year we are down to 20%. So here again, it's not only a UK problem. All this is mainly due to specific weight being well under 76, but we had also some protein problems, some Hagberg problems, etc., etc. But this is not only a problem in the UK. We'll see it's also a problem on the continent. So this situation has led to a massive increase in milling wheat premiums, specifically on the Group 1. Group 2 and Group 3 haven't followed the trend because it's really a milling wheat, high quality milling wheat issue, and it has taken milling premium to up to 55. I mean, that I think the highest traded during this season. They seem to be calming down a little bit now, simply because the imports might have taken place, and also simply because the imports are taking place now. But 55 was a very nice opportunity, and we did price quite a lot of our milling premium at these levels. Quick word about oilseed rape in the UK. So as you know, prices are at historical high levels, and I just wanted to remind here why oilseed rape prices go up. So they go up for, I would say, 3 or 4 reasons. There are 3 or 4 components on oilseed rape prices. First of all, we know, and we've seen before, we had a very low production in the UK. That was already predicted. After that, we had a very low production also in Europe, where, in fact, for the last 2 seasons, not this season, but for the last 2 seasons, we've had very dry conditions in August, September. So it's simply the farmers couldn't drill the acreage they wanted to drill. So for the last 2 years, the production in Europe went down from 21, 22 million tons to 18 million tons. So we've lost 3 to 4 million tons in the European production, which means, because we are a net importer, that instead of having to import 2 to 3 million tons every year, this year we need to import 7 million tons, including the UK. So that has, of course, tightened very much the markets. So that's one thing, lack of supplies of the oilseed rape seeds. Second element, which is the major component for oilseed rape, is the vegetable oil prices. So vegetable oil prices are given here 2 examples, which are the soya oil and the palm oil, are trading at the highest level in history. And the reason for that is mainly palm oil, because palm oil accounts for nearly 50% of the oil around the world. And palm oil, when we thought that COVID-19 would impact our economies around the world and thus impact the palm oil consumption, it has been the exact opposite. Not only China, India, and Europe has imported more palm oil than they usually do, but the main problem in front of that is palm oil is a very needs a lot of workforce to be produced and to be harvested. You don't do it with tractors, with mechanic. It's human power that produce the palm oil. And because of COVID, the 2 biggest countries in the world that produce palm oil, which are Malaysia and Indonesia, they closed their frontiers, exactly like the problem we have with Brexit in the UK and the lack of workforce, lack of truck drivers. These 2 countries have been lacking of workforce to produce and to increase their production. As a result, the productions went down. And about a month ago, these 2 countries, like Boris Johnson did, has given 32,000 visas for a new workforce to come in the country. So we expect this production to re-increase throughout 2022, but it will take time. So the situation for oil in the world is very tight, and it has given fuel to, of course, the oilseed rape prices to raise to unprecedented levels. And the last element, of course, which is very important for rapeseed prices, because about 70% of the oilseed rape consumed in Europe is consumed for biofuel, biodiesel. And when you have high crude oil prices, it increases the biodiesel price, it increases the margins of crushers, so it allows them to buy your seeds at higher levels. So the combination of very tight supplies, very high vegetable oils, and very high energy prices has made possible the very high prices you are seeing now at the moment. So let's come back now to the world markets. So it's all about stocks. As I said, we had for the last 1 year or 2 years, we had a real destocking problem on the corn and the soya markets in the world that has led to last season's price increase. And this year, we've entered into a new tightness, which is the wheat situation. So we'll cover them all today. So, but very quickly, because they are pretty easy to understand. So this is the corn stock to use ratio, what we call an element. It's a ratio that we use to to assess the level of stocks in the world. So as you can see, it went down from 15 to 10%. 10%, just for you to know, is just the lowest in history. In 2012 and 13, we've touched the same level. So this level is a very low level for corn. Another result on the blue line, prices are going up. So prices are always fully correlated to the stock levels. Same situation for soya. Stocks have been going down from 40 to nearly 25% stocks to use ratio, and prices are reacting very strongly to it. Rapeseed, same situation. I mean, the rapeseed market is a very simple market. I mean, the international trade market is very simple. You've got a very large importing geography, which is Europe, and you've got three major exporters, which are Canada, Australia, and Ukraine. And this graph is highlighting the stocks levels in the three major exporters, Canada, Australia, and Ukraine. And very easily, you can, this graph illustrates how tight and how low the stocks are, leading to prices where they are now. So the main reason for these stocks to be very low. So as I said, not only Europe has had great difficulties to produce enough oilseed rape because of weather in Europe, because European farmers do not have the difficulties you have with flea beetles, so except the north of France, but all the rest of the farmers can still grow in very good condition oilseed rape. The only problem came from very poor drilling conditions in August, September over the past two seasons. This season it has been good, but for the last season, the import needs have gone up to nearly 7 million tons, which is a huge number, of course. And simultaneously, we've had, as you might have heard, an historical drought in Canada, which has led to a 7 million tons drop in the canola production. So when the market was expecting about 21 million tons in just before harvest, the final figure came to just below 13 million tons. So we lost 7 to 8 million tons in Canada when our import needs were going up. So it is making, I would say, the European crushers' life very difficult to source the seeds. And as a result, basis and flat prices are going up. So at the moment, we are mostly relying now on Australian imports. So luckily enough, they are producing a record crop this year. They will certainly reach 5 million tons when usually they are just below 4 million tons. So this canola is going to flow into Europe very soon and could maybe endure a little bit the pressure we have on the prices at the moment. So let's focus now on the wheat. So if you look at the wheat stocks, they are going down too, and especially this year. But what is these are world stocks. But what is more important is to look at the world stocks in the major exporting countries. And as you can see, the stocks, the stocks went down to, I would say, when they were very comfortable, to 75 million tons. Then they went down to 60 million tons. They are now just at just 50 million tons, which is a very low figure historically. That's one important thing. But the most important thing is that we are talking about global wheat stocks here, but the most important thing is the quality. And we've had major quality issues in Europe, which has led to an even tighter situation than this graph looks like. So let's look at the qualities. So similarly to the UK, we've had a massive quality issue, I would say, in most of North Europe. I mean, south of France, Romania, etc., when the harvest started in early July, had not only very good yields, but an excellent quality. And it's only, let's say, as from the 20th, more or less, of July, when the harvest was delayed and we started harvesting the wheat northern than south of France, northern than Romania, and we moved to Czech Republic, then to Poland, to France, to Germany, that the market suddenly discovered the extent of the problem when harvest, first of all, it took a lot of time. We had a lot of rains during harvest, and it really came as a major surprise that the quality were downgraded so much. As a result, as you can see here, only 30% of the French milling wheat has achieved export specs. When we speak about export specs, we speak a lot about specific weight. So when normally our average is above 78 kilogram per hectoliters, our average is just below 74 this year, when of course the export minimum requirement is 76. So 30%, which means 70% hasn't met the milling specs. Big problem, big supply issue. On the durum wheat, it's even worse. 20% has met only the export specs, and France being the major exporter of durum wheat in Europe, it's a big issue. Just for you to know, I mean, the durum wheat is trading above 600 euros per ton at the moment. And it's not only France, it's also Germany, it's also Poland, it's also Czech Republic. I mean, all the north part of Europe has faced this issue, which is taking out a lot of supplies out of the export market. And this is explaining why prices have been climbing so much, and they will keep on climbing or keep on being very supported, because there won't be any chance of restocking for milling wheat until next harvest in July next year. Because there is Argentina coming now, there is Australia coming now, but the market already know more or less what they're going to harvest. So the real restocking will take place next year. So there is no possibility in the coming 6 years for this market to restock. Just to highlight quickly the extent of the situation. First of all, not only we've had lower supplies in Europe, lower supplies in Russia, but as you can see, yesterday the market went up nearly 10 euros again on Matif, and something like 8 quid on Life. And the reason for that is the more we are moving into the season, the more we discover the extent of the situation, because not only we have lower supplies, but we also have in front of it a very strong demand. So this graph on the right is illustrating the EU wheat exports. And as you can see, even if we started pretty slow because we had a late harvest, the green bars are illustrating the current export pace out of the EU. And as you can see, with lower supplies, quite great difficulties to access big volumes on the domestic markets, the exports have been very strong. So these exports are very strong, but if we were to go into the details of the origins of these exports within the EU, you would discover that nearly 70% of these exports come from the Balkans, the Baltics and Romania, because that's a place where good qualities and good volumes were. But these supplies are very quickly coming to an end, and the market will very soon rely only on France and Germany, where, once again, the quality problem is huge. So who knows what's going to happen in the coming months, but what we know for sure is that we need all the supplies to be available in the world to at least try to meet with the very, very high international demand we have at the moment. And we'll see afterward that there is a stronger than usual international demand. But simultaneously, like if all this wasn't to take prices up, Russia and Mr. Putin, who loves playing with the market, he's playing with the gas market, he's playing with now with the wheat market, has announced about 2 or 3 weeks ago that he will limit, as from the 1st of Jan, the exports from his country. And the reason why he's doing that is that food price in Russia are highly sensitive, and he wants to cut into the domestic prices inflation. So he had already implemented some export taxes to limit the food price inflation. It doesn't seem to be working because there is a strong price inflation at the moment in Russia. So he has decided not only to maybe increase the export taxes, but also to limit the export through quotas as from the 1st of Jan. So if this was to happen, we could lose another 3 to 4 million tons out of Russia on the export market. And at the moment, this is really the last thing we need. So prices are reacting very strongly to that. And no matter what we think about that or we analyze it, this market is very tight. Just a quick word for the one of you who I'm sure have heard about the Chinese situation. So to explain what's going on in China, it all started with the pig industry or the pig situation when they had the flu about 3-4 years ago. They decided to just, as they can do in China very quickly, to stop or to prohibit any small units pig production on small farms. So 3-4 years ago, the majority of the pigs in China were produced in very small farm units, millions of very small farm units. So this is now forbidden, and they've moved it to these massive production units where they produce millions and millions of pigs every week. Just for your information, a unit like that can eat up to 16 Panamaxes per week, and Panamaxes of corn, Panamaxes of soya meal, etc. So not only they are producing massively and concentrated massively the production, but also these pigs that are produced in these units eat proper food. They eat corn, soya meal, etc. When these pigs, of course, were not fed with a proper food. So this has led to a massive increase in Chinese demand, and it has led last year, but it could happen again this year, has led to a massive increase of the Chinese import needs. And it's not often that demand impacts the world prices. Okay, usually demand goes up 2-3% every year, but last year we had a sudden change, and I will explain you why it is so important and what could happen in the future. So first of all, it's easy to understand on this graph that China was a very small grain importer for the last 10, even you can move even before, a very negligible importer in the world, from 1 to 5 million tons every year. And suddenly last year, they imported 26 million tons, which makes all the difference for prices. So the reason for that was partially a lower crop, but most importantly, a much stronger demand from the pig industry. That was last year. For this year, this crop, 2021-22, they already imported a lot, but that was about 3-4 months ago. And since then, they haven't imported anything. But we reckon, and we'll see afterward, that they could come back on the market massively and could really change it all. So to explain you very quickly why, and this is a bit of knowledge transfer, why 21 million tons higher demand can change it all. And I will explain you how world prices are fixed. So in fact, if we take the example of corn, the world produces more or less 1.5 million tons of corn every year. But only out of this 1.5 billion tons every year, only about 200 million tons are traded in the world. The rest are consumed domestically. And it's this yellow part, these 200 million tons that are trading every year, that sets the world prices. So if you add to 200 million tons, you add an additional and sudden demand of 20 million tons, it's a 10% increase in the demand. And that makes all the difference. And that made a 30 to 40% price increase last year. This additional demand from China made a 30 to 40% price increase in the world corn prices, and thus to your feed wheat prices. Okay, this is very important to know. I mean, it's a very small portion of the world production that sets the world prices. It's the same for wheat. About 200 million tons are trading every year. It's this yellow part that makes the world prices. Same for barley, etc., etc. So to come back to China, because China is very difficult, of course, to analyze and to predict. It's very a very untransparent country. So the best way we analyze this market, and we try to predict their potential import needs that could impact the world prices and thus the UK prices, is that we look at the spread, the difference between the Chinese corn price, which is in blue, with the imported price from Brazil, from the US, etc. So normally it trades at around the Chinese price always trade around $50 to $60 above the world market. As you can see, last year when we had this massive import needs, it was trading up to $150 above the world market. So for a Chinese pig producer, it was $150 cheaper to import some corn from the US than to buy it on the Chinese market. Thus, this massive import. Then the market has the spread has smoothed, I would say, to more or less minus $50, which means that at this level, more or less, the Chinese importer doesn't look into the world market. And as we can see, the spread is going up again. And if we move, I would say, above $80, $90 per ton, it could be the trigger once again for the Chinese to come back to the market. So a situation to watch for very carefully. They are not only buying corn, of course, they are buying massively wheat, which they didn't do before. As you can see, for the last 10 years, they didn't buy anything. And for the last 2 or 3 years, they are buying, again, some wheat from Ukraine, from Europe, and some barley too. And these new purchases, about 2.5 million tons here, 1.5 million tons, are really here again making the difference at the world or at the European level. For last month, the biggest importer of European wheat last month in October was China. So it is making the difference. Now, if we move to, of course, the weather markets, weather are essential to predict the prices. So most of the northern hemisphere now drillings are done. We've just finished with corn. So we are, of course, now very much focusing on the weather for the plantings and for the crop developments, and then we'll move through the winter, etc. So the good news for the moment is that the European globally, at least the Western European weather has been very friendly to drillings and crop development. So everything's looking good in France, in Germany, in the UK. There are a few dryness issues in Czech Republic, Poland, and north of Romania, etc. A few issues here, but globally, speaking about wheat and oilseed rape, there is a high probability at this stage that the 2022 production will be much higher than this year at this stage. So for the moment, we are favoring, I would say, a restocking year next year. A situation is not similar in Russia and Ukraine, where there has been, like last year, a pretty strong drought during and after the drillings. So here it has clearly impacted the drillings. There is a lower acreage of winter wheat drilled in south of Ukraine and in Russia. So we will for sure not expect for record crop in Ukraine and Russia next year. Nevertheless, it's not a disaster yet. So let's not be over pessimistic, but it's really something we are going to follow very closely, and it's a real alert for next year. And it's also giving a bit of fuel on the new crop prices. So globally, all good in Europe, but Ukraine and Russia under alert. The next, of course, geography where we need to focus our attention regarding weather is Brazil and Argentina, where, Brazil and Argentina, Brazil is second world exporter of commodities. Argentina is the third one. So they are very important. As you know, might have heard, they had a disastrous crop, especially Brazil last year. They had their worst drought in 100 years because of La Nina. And La Nina is for dry weather during the summer in Argentina and Brazil. So we are focusing very much our attention towards these two countries. So the good news for the moment is that the drillings and the crop developments conditions have been very favorable. So they've drilled in time. They've got very good moisture. So far, so good. Everything's going on well. But once again, La Nina is looming again this year. Just before we started this webinar, I've been informed that the Australian Met Office has said that 100% the probability of La Nina is now 100% for 2022. So let's be cautious. We could have another drought event in South America, and in that case, it will certainly create a new, or it could create a new production incident. But so far, so good. At the moment, everything's going on in South America. Going on well in South America. So we of course watch out for US weather. So the US harvest of corn and soya is coming to an end. So they've had a disastrous wheat harvest because of drought. They have one of the biggest harvests. I think it's the second biggest harvest of corn this year. It's coming to an end. About 91% harvested now. So it's all good. No big issue coming from there. We are watching also very closely the Australian situation where they are about to harvest their third or second largest wheat crop in history, which is going to, of course, relieve very much the world wheat supply and demand. But for the last more or less 2 weeks, they've had a very rainy weather, especially on the eastern part of Australia. But some part of the Western Australia is also being hit by pretty strong rainfall, which, well, it's not assessed, it's not defined yet, but which is impacting here again the specific weight, the bushel weights levels. So the market is reacting strongly because, of course, every million tons of milling wheat out of the SND is it's a major issue considering the current tightness. So it's giving fuel, at least at the moment, on the market because the quality is being impacted. We will need maybe another 3-4 weeks to assess the extent of this quality degradation. But it is giving fuel again to the world market for sure. And one other thing about weather is, of course, we focus very much our weather analysis on the exporting countries where they produce most of the surplus for the world markets. But this year there has been, and the markets are not talking a lot about it, but there has been also a severe drought in Iran, Iraq, Syria, and also in some other parts like Morocco and Sudan. And these are clearly increasing a lot their import needs. So not only we are having a supply issue, but also these major importing countries will have more needs than they usually do, and that can be defined as maybe another an additional 10 million tons of import needs in these countries. So they are already communicating each of these countries on 1 or 2 million tons more import needs, but we reckon it can be more. Now let's move to maybe what's going on now. So you saw yesterday prices going up nearly 10 euros on Matif. You saw when we closed Friday already at record high levels. On Chicago, wheat is at a 12 years high. On Matif, it's historical high. On Life, it's historical high. So what's going on, and what is giving even more fuel to these prices to move much higher? There are 3 or 4 new elements that came in the past few days that are, I would say, pushing the prices to move even higher. So we know the situation about low stocks and low quality in Europe. The new element that is really stressing the market is clearly the quotas in Russia. We don't know yet exactly how they're going to impact the market. We don't know what will be the limitations. Okay, but what we know, and which is clearly stressing the market, is that Russia is playing a very strange role at the moment. So we are coming back to geopolitics. We know they are threatening Ukraine again. We know they have, I think, gathered 100,000 soldiers at the frontiers with Ukraine. And Ukraine and Russia being the two major exporters at the moment in the world of wheat, the market is getting stressed, and we are all getting stressed. So if there was during this winter, because they predict to do it, if they were to do something, they would do it during the winter, that this would certainly have a major impact on the exports, logistics, etc., on the Black Sea. So this is a clear element of stress, because supplies could be limited not only by quotas but also by geopolitics. As I just mentioned, Iraq, Iran, etc., are communicating weeks after weeks on higher import needs. Last week, it was Iraq saying that they were going to need 2 million tons more than what they initially thought. China also mentioned it. We are seeing years after years higher import needs, and there is a real question mark on if or not they're going to move in the coming 2 or 3 months to buy more on the world markets, and they could act pretty aggressively. And for the moment, the spread is showing us that they could act soon. Quality risk in Australia, this is also a new story. It appeared in the market in the last week, so it is also adding some risk on the supplies. La Nina, that has, we had a 60% probability for La Nina to be back next year. As I said this morning, it looks like it is now 100% sure. That could impact again the South American crop in February, March. And last but not least, we I don't know if you heard about that, but there has been massive floods in Canada that have cut all railways, motorways, etc., access to the major ports in Western Canada, which is simply cutting not only the exports out of Canada, wheat exports, oilseed rape exports, but it's also cutting the ability, because these ports are massive also production places where they produce a lot of, for example, fertilizer, and this fertilizer for the moment is not able to flow into the farms, where they need, of course, this logistic to get all their fertilizer supplies, etc., for the spring crops. So it's a real threat. We don't know. It's very new, so we don't know how long it's going to last. But once again, given the great tightness in the world, having a logistical issue in one of the major world ports is a problem, and markets react very strongly. So if you take all of this, it explains not only why the prices are going up, but why they went up so strongly yesterday, because some of these are new news to be followed up very strongly. But now, if we take a little bit of a helicopter view, if we, I would say, take out a bit of emotions out of this market that are really driving us to unprecedented levels, and let's look at history. And the history of live wheat is interesting. Each time in the past, I would say 20 years, we've reached or nearly reached 200 quid. 1, 2, 3, 4. So it's the 5th time in the last 20 years that we reach or overpass 200 quid. And each time we did that, what happened next is prices fell by sometimes 50, 60, 70, 100 quid. It has always happened like that. It doesn't mean it will happen in the future, but it needs at least to raise the question of what's going to happen next. Why do prices climb so high? And when they climb so high, what happens in the market? So as I said at the beginning of this presentation, prices climb to these levels to ration the demand, and secondly, to incentivize farmers to drill more. So I'm sure many farmers are listening to us. So when I speak to UK farmers, I know they have all drilled as much as they could. When I speak to my clients in Czech Republic, in Romania, in Poland, in France, everyone has done as much as they could. No matter the fertilizer cost, with current prices at 270 euros on Matif and 210 quid on Life, it is still profitable despite higher cost to drill. So farmers are doing their job. So there is a high probability for this market, this Swiss market, to restock in 2022, unless we have a massive, once again, weather disaster. But at the moment, so far as we speak now, there is no major disaster in the world. It's the opposite. It's going on pretty well. So if this market was to restock next year, these prices will not stay where they are. And we are talking about 210 at the moment on Life new crop. We have to consider taking opportunities at these prices, no matter what. So we should not engage, of course, too much. We have to act step by step, but not acting, looking at price history very coldly is a mistake, because I would prefer, I'm sure a farmer would have preferred to have acted at 200 here rather than 235, because 6 months later, the market would have been at 150. So don't hesitate to sell in a rising market, and be extra careful about the prices falling down very strongly when the probability of restocking occurs. So our view is very simple. It's the old crop market that is taking all the complex up, oilseed rape, wheat, corn, barley, etc. So it's all driven up by the old crop market. Given the very high cost of producing crops next year because of fertilizer, fuel, etc., we reckon the prices will need to remain high enough until at least March or April, when the spring crops will be drilled. So spring crops are not that important in the UK, but they're highly important in the US, highly important in South America. Okay, 70% of the corn in South America is drilled in February. It will be highly important in Ukraine, etc. So we reckon, because of high fertilizer costs, that the corn prices, soya prices, etc., will need to remain high enough to incentivize farmers to drill in March, April. And once this will be done, if there is no major incidents, I think the market will start focusing on the new crop and leaving apart a little bit the old crop situation. And then the prices will, not certainly, but very probably, fall back to what I call the natural level, the balance level, which is certainly lower than where it is now. So here, ourselves in ODA, we look at that very carefully. Our strategy is clearly to engage more forward sales than we usually do. So between now and March, April, we will engage to take quite a lot of forward sales. I think we will certainly get to nearly 50% of forward selling on the physical market between now and March, because we believe the probability, we don't know if it's going to happen, but the probability of having prices collapsing like they always did in the past is high. Quick word about fertilizer, because this is clearly one of your main focus. Two things about fertilizer. Like most of commodity prices, as you can see, when they went to the roof, like this year in 2008, look how strongly they can collapse. So first of all, this price increase usually never lasts for too long. That's the first element. Second element, a question that is very often raised by farmers is how will it impact the 2022 production? So as I said, and I speak really with farmers in Argentina, in Brazil, in the US, in Eastern countries, etc. There's not one single farmer who told me that he was not going to drill massively because of the high fertilizer cost. I mean, clearly the market always works perfectly. So if you have allows you to have very good margins. So two solutions, I would say two scenarios for the high fertilizer cost. One, which we don't believe which we don't believe would be a lower planted acreage by farmers, because costs are too high, they don't want to take the risk, their margins are too low, etc. And in that case, if you have a lower acreage, it would be very bullish for the prices. Second scenario, prices, which the scenario I favor, world prices will remain high enough to allow farmers, because we need them to do it, to plant massively next year, despite the higher cost. So prices will remain high. Once this job will be done by the market and the prices, so sometimes between February and April next year, we believe that the prices will collapse, because it will have done its job, which was to ration demand and to incentivize the farmers to drill more. Once markets will have considered the farmers have done the job, prices will come back to their natural level, which is much lower than where it is now. I have put this graph also. These are the ocean freights. So ocean freights also went to the roof, record levels, and that has a real influence on our prices. But I've put this graph just to highlight how quick prices can go down. I mean, in September, we were at a record level. 2 months later, we've lost nearly 50% of the price increase. So I'm not going to explain why it's going up and it's going down, but it's also to explain how quick the prices can go up. We talk about gas prices, we talk about fertilizer prices, we talk at the moment about wheat prices, but they never stay at these levels for long. Never stay. Okay, this is not a natural level. And look how fast things can go down. So always keep that in your mind. So what are the downside risks for next year? Because we've talked a lot about bullishness, etc. So as I said, for me, the major risk is restocking. So we will not fully restock, because once again, demand is also increasing year after year, etc. We won't fully restock. But I think if farmers do their job, because prices are high, markets, S&Ds will be more balanced next year, and a restocking event would take prices to a lower level. So for me, this is the major risk. And then you've got outside risk, more political risk, like biofuel policies. Biofuel policies are set by the government, and because of the great tightness to feed the people, simply to feed the people or the animals at the moment, there could be, and there are many debates around the world. Brazil has cut already their incorporation rate for biofuels. There are many talks in the US, in the Biden administration, to lower a little bit the ethanol incorporation rate. It's still under debate. It's, I think, quite unlikely that they will lower the incorporation rate, but they could do it. And if they do that, it's tens of millions of corn demand that just vanish from the market. So this is a risk, and could be a risk also in Europe, because if we had real supply issues, to feed the people and the animals, I mean, the incorporation rate could be lower. So this could come suddenly, and this is to be considered a risk. It's not happening yet, but it's a risk. Financial crisis for me is also a big risk. Our markets are correlated to financial markets. So financial markets are at also record levels, all fueled by free money everywhere, very low interest rates, etc. We are now facing an inflation. We are entering into an inflation cycle. Currency rates will be certainly raised, etc., etc. So let's be careful. Markets never climb to the sky, and if there was if this inflation was to continue for a long time, interest rate could increase, financial markets could drop, and thus take energy prices, economical crisis, etc., could take also partially our prices down. Currency is also always a risk, but we are not currency traders, but we always have to take into account that a currency can move by 10-15% in a year. COVID-19. Well,
2 minutes, please, Sébastien. 2 minutes.
Yeah, COVID-19 is a major risk. We saw that we are seeing that new lockdowns are being decided in Europe. It can impact the economies. It can impact the energy prices, etc. Thus impact our demand. Yes, this is more or less the end of the market presentation. I just wanted here on this last slide to highlight the fact that in ODA, we consider ourselves, of course, as advisors. Of course, we send some independent information to our clients, etc. But I think really the most important things for us is to train the farmers. We've trained 15,000 farmers around Europe since we were created 20 years ago. So this is what we do, and that's what we do for free for the farmers. And I just wanted to highlight here that learning experiences. So it's a twice 1 hour webinar on which we focus on the UK market. What is the theory of marketing for a UK farmer? What he has to do? What is the minimum thing he has to do and to understand on his local market? And he can make quite a lot of money out of it if he applies the theory of marketing. Then we have a second module which explains how the world market is influenced by fundamentals and how it correlates to the UK market. And then we end with risk management tools and how to manage your risk. So I think this is first of all, it's a must-have for farmers to take informed decision. And it's interesting, and we usually have quite a lot of fun. So if you want to take a screenshot of that, you can contact one of our consultants, Jeremy, who is in charge of this, or otherwise you can subscribe through our webinar, our website. So that's it for me. Of course, feel free to contact us if you have any questions, or feel free to post them now. Markets are the market news are very rich. There is a lot going on. It's not only about fundamentals, it's also a lot about geopolitics now. It's a lot about currency. It's a lot about energy prices. I mean, there is a lot going on. So be prepared for at least 2 or 3 years of high volatility. And given the circumstances at the moment with lower subsidies in the coming years, more difficulties sometimes to grow higher cost, I really, really advise all farmers through ODA or through any other source to get well informed by independent sources, because there is a lot to be made on your final price. That's my conclusion.
Thank you very much, Sébastien. You addressed the vast majority of questions that were posed by the audience. Much appreciated. There's one burning question that appears to arise from a number of people, just very simply: how high can prices go?
That's a very tricky question. So, well, there is a roof to everything. I think this year more than another year, so once again, it's a wheat-led market, and it's a milling wheat led market. Milling wheat demand is very difficult to destroy or to ration, simply because milling wheat is for bread, or it's for the Northern African, etc., to eat their couscous, etc., etc. So they will not cut into this demand. So we are seeing that the higher the prices are, the higher and the stronger the demand is. So you cannot just starve people. So milling wheat is very difficult the milling wheat demand is very difficult to destroy. So the only possibility today is to resupply, this market, and resupply will not happen until June, July next year. So regarding this market, and because it is so difficult to assess exactly the amount of supplies available in the world, because we have a real quality issue, the answer will come either to importers lower their minimum specs needing for their milling. Okay, they could lower the specific weight to 74, to 73 to have access to more supplies. But otherwise, as I say, it's very difficult to assess. So most of the traders I speak to, because I speak with a lot of traders and brokers, have in their mind something like 330 on Matif. We are 310 at the moment. So that would make about 250 on life. And I think the more we will start entering into next spring, so Jan, Feb, March, the more the market will start focusing on next crop. And here could be the trigger for market fall. But until then, if you were to consider taking the best opportunity of the market price increase, I would call it from now till more or less Feb, March 2022. And then be careful, prices could collapse.
Sébastien, thank you for that. Ladies and gentlemen, we are running out of time. There are one or two other questions which we will email those responses back to you. So thank you very much, Sébastien. Ladies and gentlemen, thank you very much for your attendance and the questions you've actually posed through the process and within the broader publication. Please note this webinar will be available on demand and you'll be emailed after this meeting. If you look to the bottom of your screen under resources, you will see that there's a single ODA weekly publication. We hope you find it interesting. Please review it. It's very topical. In addition, you'll see a link to the ODA website. Please register, and this will provide you access to the contents of the website, including futures markets and foreign exchange. Last but not least, please feel free to contact us directly and address any additional questions you may have. You will find this in our website via our biographies, via the registration to this paper, and also, as you can see in front of you on Sébastien's slide. Please feel free to take a photograph of that as we speak. Thank you very much for being with us today. We look forward to hearing from you. Enjoy the balance of your day. Goodbye.
Thank you. Goodbye.